Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio, we have Michael Rosen, Chief Investment Officer of Angelus Investments, to discuss consumer spending, earnings, and the strength of the U.S. dollar in a tight monetary policy environment. Michael, it's great to have you with us. Welcome to Trade Talks.
Good to be with you.
Let's talk about the macro for a moment here. What are your thoughts in terms of the recession that has yet to materialize and your macro outlook in general?
Yeah, so the market's been expecting a recession for the last year or so and has just been wrong. And all the evidence suggests that the economy is actually gaining strength, not weakening at all. So I think a recession in the near term is very unlikely at this point.
And how do you think the Fed is going to adjust its policy? Do you foresee another rate hike this year?
No, I don't think so. I think the Fed's going to be on hold for now. Again, I think the economy is strong, but inflation's coming down, and I think the Fed just wants to see how things play out, and we'll keep rates where they are. I think the bigger disconnect really is in the long end of the curve, where bond yields are so much lower in longer maturities than in shorter maturities. It's an expression that the market is expecting either a recession or the Fed to start cutting interest rates pretty dramatically, pretty quickly, and I just don't really see that happening. So to me, the disconnect really is more in the long end of the bond market than in the short end.
Speaking of inflation, the data is coming down. It's better than, it's getting better. It still feels like things are very expensive. I mean, anecdotally, we have gas over $4, at least in New Jersey, where I live.
Yep.
What are your thoughts around the consumer? We know student loan payments are going to start to come back online. We know COVID savings has dwindled down. Do you think that they're going to continue to be as strong as they have been?
Yeah, that's a great question. So with respect to inflation, the headline data that we see, gasoline prices that you mentioned, cost of food, eggs and milk and things like that are certainly a lot higher than they've been over the last couple of years or so. So that's something that we see every day in the prices that we pay. But of course, CPI is more than just food and energy. It's a lot of other things, and so that's why the data is coming down. But it doesn't really feel like inflation is improving all that much, I think, for that reason. That said, the consumer is actually in really pretty strong shape. I mean, and has been spending money pretty rapidly. I mean, you can just sort of see it with. It's very hard to get a restaurant reservation. It's all full. The airline flight I had out here, every seat was taken. That's been the case now for the last year or so. Very hard to get Taylor Swift tickets or Beyonce tickets. You may know that.
Yes, where they contributed $4 billion to the economy, I think just
right.
for Taylor Swift alone.
Right.
So it's on the services and the consumer.
Yeah, that's right. So the consumer's spending money, certainly. It's some of it's coming from savings. That savings was generated by the massive amount of fiscal stimulus that we had over the last couple of years, partly. But more importantly, it's really coming from rising wages. Incomes are up, and they're actually now just sort of keeping pace with inflation. Before, it had been a little bit lagging inflation, but now it's actually keeping pace with inflation. So the consumer looks like it wants to continue to spend, and some wise person once said, never bet against the American consumer. It's probably good advice.
How about earnings? I mean, earnings were okay this season.
Yeah, so earnings were expected. I mean, if you remember a year ago, the market was expecting a recession and earnings to come down by 20–25% or so. And that's now been sort of revised. Earnings are down a bit from last year, but not nearly as bad as what was expected. And over the last couple of quarters, we've seen earnings in almost every sector where the vast majority of companies are beating earnings expectations by a reasonable amount. And we're now just beginning to see earnings estimates start to ratchet back up again now. So I think it's just really a reflection, or maybe just sort of catching up to the reality where earnings have been strong, profit levels are strong, and that really explains why this market has been going up this year.
What are your thoughts around the U.S. dollar? I mean, we know we're going to be in a higher for longer monetary policy environment. What are your thoughts around that from an international perspective?
Oh gosh, people have been expecting the dollar to collapse now for a couple of years, I think, and again have generally been wrong. The dollar did fall in the fourth quarter of last year and into the early part of this year, but over the last 2 months, the dollar is up, 4 or 5% or so. So the dollar's been strong again. The reality is the U.S. is the best place to invest in the world, and I think capital continues to flow here as it probably should, and that's helping to support the dollar. Certainly the higher interest rates that we have here, interest rates are higher here than they are abroad, even at 5–5.5%, which in a historical perspective is not all that high. It's certainly higher than it is in Europe or in Asia. So it continues to attract capital. And when you think of the investment opportunities that exist in the U.S. versus in Europe or in Asia, the U.S. continues to look attractive and continues to, I think, help support the dollar. So I think calls for the collapse of the dollar is a little premature at this point.
So when you're recommending portfolio adjustments, how would you be positioned with this backdrop?
Well, we're global investors, so we're looking around the world for investment opportunities. Our clients are endowments and foundations and families, and again, we're looking for the best opportunities that we see. That said, we've generally been, for the last 10, 15 years, very overweight the U.S. relative to global benchmarks for really the reasons I explained. U.S. companies are more profitable than non-U.S. companies. The investment opportunities are just really better here. So we continue to be overweight the U.S. and generally our outlook. With respect to fixed income, as sort of I mentioned, this disconnect in the bond market, we've kept a very short duration in the portfolio to capture the higher yields and not expecting a recession, or at least not expecting the Fed to cut interest rates dramatically as much as the market seems to be pricing in there. We had moved mostly into Treasury bills about a year and a half ago, and as our confidence in the economy has increased, we've increased our exposure to high yield bonds as well. Again, not expecting, well, certainly defaults may be rising, and certainly in the lower rated securities perhaps, but overall in the market, I don't see a sort of a systemic structural default cycle moving, and picking up another 300 to 400 basis points in yield seems pretty attractive. So within equities, overweighting the U.S., and within fixed income, keeping it short on the duration side.
All right, Michael, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.